Ladies and gentlemen, good day and welcome to the Q2FY22 earnings conference call of the Federal Bank Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Anand, Head Investor Relations. Thank you, and over to you, sir.
Thank you so much. Good afternoon, everyone. Hope you would have seen the numbers and you would have seen that this quarter has been a pretty solid quarter for the bank. Before I hand it over to Shyam for his opening remarks, I would like to bring to your attention some accounting change that has been brought in because of in compliance of RBI circular dated 30th August 2021. Couple of changes which are important for all of us to note. One is that recovery from written off assets, which earlier used to be accounted under other income, now has to be netted off against the provision line, provision for NPLs. Also, any provision or depreciation for standard investments, which was earlier accounted under provision and contingency, is now netted off against other income. So these are two changes, and wherever number one, there is no P&L impact or the bottom line impact of any of these provisions, but there is some line items have moved from A to B and B to A. And second is, just wanted to ensure that all of us are on the same page. We have brought in some adjusted the past numbers so as to give you a comparison of quarterly numbers on a like-to-like basis. So I'm sure all of you would have taken note of that. And with these opening remarks, I would possibly request Shyam to give his commentary on the quarter gone by, and then probably we'll proceed with Q&A. Over to you, Shyam.
Thank you, Anand, and good afternoon, everybody. Like Anand mentioned, we do think that we had a good quarter given all the challenges in the environment. We are seeing a good traction on the many initiatives the bank has been putting in for long periods of time, and we've literally try to build the bank brick by brick, and it's good to see some of them coming to its rightful place. Most important being the asset quality of the bank. In particular, this quarter was a great tribute to the efforts of the bank. We did see slippages very modest, but recovery upgrade way above even slippages. Considering that we did have slightly elevated slippages in the last quarter, we saw them come back quite well. So as a consequence, credit costs for the quarter was flatteringly remarkable, with literally no credit costs for the quarter, which would be a very happy place if we were to repeat it all the time all over again. Interest income grew well and I was at about 1479, our all-time high. Noteworthy was a very strong traction on fee income, non-treasury. Core fee income grew very smartly, and CASA continues to be our sort of strong bet, and we saw that go up to 36.18% this quarter. And our liability franchise continues to be one of the most coveted, I would say, with a large part of it being absolutely granular and retail. So the quarter that went by, we do see the credit pick up in many areas, and most of them are seeing traction as we go into the second half of this financial year. Many areas of retail have started seeing good momentum. Happy for us that business banking and commercial banking have also started seeing growth, and we saw annualized for the quarter roughly 12-13% growth, which is a good sign, and that's not by diluting credit standards but by increasing our coverage, penetration, and sort of competitiveness of our offerings. So in short, the quarter did see good progress on many counts. The numbers are there for you to see. It did see 50% growth over last year, same quarter net profit, and sequentially 25%. But I think those are less relevant from a long-term point of view. Our commitment to get to that sort of minimal requirement of 1% ROA and keep heading north from there is well on course. This quarter was 0.92, and we believe that, as mentioned earlier, the financial year 21-22, we will see exit at that 1% plus ROA, and then keep moving along that line. As I pointed out in our earlier interaction, we believe that 1.2, 1.25 over the next two financial years is what we will seek to do. And there are lots of initiatives that we've put in place to make sure that those come alive. There is one challenge which is visible for everybody, is the the people-related expenses have shot up, not because we've hired more or paid ourselves more, but this has a long-standing bearing on the pension costs and the recent announcement by government and the IBA negotiation for family pension and the increase in annuity costs, the DA going up. These have unfortunately skewed the pitch, but I've decided that there's no point being either defensive about it or worrying too much about it. What we can't control, we will just work through other lines and ensure that our desired outcome of 1% plus ROA is well on course and not get distracted by these, which seem to now be something that we have to contend with. That said, there are lots of initiatives. Many of you would have seen an internship program we've launched, which is the first of its kind, and we believe over the next 2 years that will give us both sales momentum and keep our front-end origination employee costs much lower, because a salesperson who comes in through this program gets interned and also can do a sales job. So we think that's one of the initiatives we've taken to cover off some of this cost, which is a longer-term problem, in addition to our great and well-run FedServe proposition, which is helping us take away a lot of the costs. The last part, an important point, which you may have all observed, we have a fetish and a feverish pitch on digital and fintech. I have personally spent disproportionate time, and Shalini as an executive director probably spending a large part of our time on getting this going. We've created exclusive teams that are focused on this. At this point in time, there is a cost element to it, but we are willing to take that cost because we believe that in the long run, this is going to be a federal bank completely differentiating from many other banks. 6 years back, I said our strategy is digital at the fore, human at the core, and branch-like distribution heavy. We haven't added branches. We've added RMs. We've put in a digital stack. That stack is helping us covet the fintech players to covet us as their partner bank. You may have seen we've got very good partnerships. The last 3-4 months, we've seen about 3-4 lakh accounts being opened. These will graduate. It's not going to be an instant win where they will all start building balances and become huge portfolios. But we believe that done well, this is going to be a game changer for Federal Bank in terms of being the truly one bank which has a hybrid model of digital and conventional banking practices coexisting. My words may seem like a flighty statement now, but I think we have the conviction that this over periods of time will be something that Federal Bank will be truly differentiated. If you poll any of the partners in the market, they will clearly believe that our model is something that they respect a lot, our engagement model and the technology capability. And this is something that we are investing into. So my headline opening messages, performance has been pretty reassuring. We believe that our promise to be that 1% plus ROA bank is well on course. We are not taking our eyes off all the deliverables. The efforts have been quite determined. The growth in NIM, NII, and consequently NIM is visible. Core fee income is tracking well. Generally, business momentum is beginning to pick up. Credit quality in Q2 was remarkable. I forgot to mention. We did restructure about 1,000 odd crores of assets, which we will come to, and I'm sure there'll be question and answers around that. And we have made sufficient provisions for that, also anticipating what kind of slippages may happen over the next 2 to 3 years on that book and build up. And I said about 5 quarters back that our PCR will never come below 65, and we are confident that whatever happens, that number will be honored, and we are tracking quite well to make sure that not just this quarter, but in periods ahead, those numbers will be contained. So with that, let me just hand it over to the operator. You may open up for questions. Thank you very much.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who would like to ask a question, please press star and 1 at this time. Ladies and gentlemen, we will wait for a moment while the question queue assembles.
So what I mentioned, the entire senior team is there. I don't know if Anand mentioned it. So they will be able to answer pointed questions in specific areas.
The first question from the line of Renish Bhuva from ICICI Securities. Please go ahead.
Yeah, hi sir, and congrats on a great set of numbers. So sir, just first question on the margin side, so which is currently at 3.2%. Now in context with the lowest ever cost of funds and broadly loan mix is also at a desired level. So how do you see margin sort of behaving over next couple of years? And also if let's say interest rate cycle has to reverse, maybe within 6-9 months, then how we are positioned to sort of get the benefit, or is there any risk to the margins?
I think between business, I've always said, Renish, between business mix, the growth in our low-cost deposits, and the reversal of interest income because of lower or higher slippages, the combined makes the margin look good or bad. And we've always guided at 320, 325 is where we will be. We are at about 320 now. And I think the business mix and hopefully more modest slippages in passage of time will cover up for whatever interest rate costs that may go up in periods of time. But, it's obvious if you look at our ALM profile, we may be amongst the best players when the interest rate cycle turns up. So I am not, and we are a largely retail franchise, right? So right. I'm not that alarmed by interest rate increase by itself. I also think sanity will come in the pricing structure for credit, because at this point in time it's kind of sort of at some point it's almost sometimes sounds insane. I see some kind of order will come in the market in the quarters ahead.
Got it. So just a follow up on this. So let's say whatever new products we have launched over let's say last 3 to 6 months, maybe in terms of MFI or credit card, or over next 6 months we're gonna scale the CV book. So directionally the margin should settle at 3.5, 3.4, or do you see, or let's say do you expect this is too early to comment on it?
No, I have never commented on that far ahead, that higher number. I've always said 320, 325. So we will work on it. We can only give you the mix of the business, the kind of credit quality, and almost as a derivative you can derive the number. But at this point in time, my sight is 325 max 330, but I'm not commenting beyond that.
Got it. Okay, sir. Fair enough, sir. So next question is on the other operating OPEX.
Renish, you may get blamed by others for hogging the show, so be careful.
Yeah.
Go ahead, please.
Yeah. So other OPEX, went up by 20% sequentially to now in absolute terms almost touching 50 crore, to be precise 48.7 crore, versus let's say 35 to 40 crore 4-5 quarters back. And since we have not added any branches, I'm assuming these incremental 10-15 crores is largely towards building the technology platform on all those things. So going ahead, do you see this OPEX stable at current level, or we still have to invest more maybe over next couple of quarters? How one should read this OPEX line item?
So the OPEX line, in parts, for example, the increase this quarter, a significant part of the increase is the variable one, which is linked to, say, the sourcing cost, which we pay to our DSAs or FedFina, or what has been our hiring business cost, what we pay for Rupeek for our gold loans. So to that extent, this is a variable. If volume comes, business comes, this cost comes. So I'm not, I'm not too worried about that. The part that is unfortunately not, I know it's quite silly for an MD to say that, but I'm not in great control of, is the pensioning and the annuity cost, which we are working alternatives. I don't have a direct control over that. We are in fact working with the government to remove that Rule 89, which allows us to self-insure, so to say. I don't have to buy annuity. But those are a little long shot. Our OPEX by itself, non-people, is not something that we are nervous about. It's very much in control. We don't have any extravagant expenses. All our expenses are volume related.
Okay. Thank you, sir. Got it.
Thank you. Ladies and gentlemen, in order to ensure that the management will be able to address questions from all participants, we would request you to limit your question to 2 at a time. Should you have a follow-up question, please rejoin the queue. Thank you. The next question is from the line of Mona Ketan from Dolat Capital. Please go ahead.
Hi, sir. Good evening, and congratulations on a good set of numbers. I have 2 questions. Firstly, on the business banking and commercial banking book, we have seen a very good growth on a sequential basis, 7 to 8% each. So what are the incremental yields in this segment, and any commentary around the demand scenario and the customer acquisition strategy will help? And my second question is around your remittance market share, which has increased to over 20% from 17.5 1 or 2 years back. So, what is helping this rise? Some color around that. Thank you.
Thanks, Mona. I think glad you pointed out the remittance. It was in my opening remarks. I missed mentioning it. Yes, this quarter was, it comes with a 1-month lag. So actually, it's the August end number, if I recall right. Shalini, would that be right? It's the August end number, right? Our share, or is it in the September end?
The June end, yeah. 1 quarter lag.
Sorry, 1 quarter lag. So we have, literally become a fifth of India's remittances, which is, it's been a focus for the bank now for many years, and from about 6% share now at close to 20% share over the last 7-8 years is something that we are greatly proud of. It is, like I said at the top of the call, brick by brick, we have field presence, we have technology capability, we have very good partnerships, good offerings, and speed to market. And every time some competitor blinks, we are there to take that share. So I think we've had, it's a focus of the bank, and we believe that we will do everything to protect that. So I'm happy that the 17 has become 20. We have some internal ambitious targets, but yes, this 20 would be our sort of what we would try to preserve. On your part on growth in business banking and commercial banking, we've always said that these are incremental growth opportunities for the bank. So it's an area that we are quite strong at. And after we verticalized more sharply, there are RMs covering each of these businesses, and branches are helping our business banking flourish, and the RMs are focusing on the commercial banking. So there's a sharp line of sight. I think opportunity exists as India comes back and growth comes back. We will see a bigger share of our pickup on that. Yields are not, I'm not saying that these are disproportionately higher. It's certainly much better than corporate banking, and it's more granular. So we are more excited about this business. The commercial banking is somewhere in the 9 plus, and the mid 8 to 9.5, and business banking is a touch higher, 9.5 to 10.5.
Thank you.
Thank you. The next question is from the line of Gaurav Kochar from Mirae Asset. Please go ahead.
Yeah, hi, good evening, team. Thanks for taking my question. Sir, my first question is with regards to the liquidity on the balance sheet. If I add the cash and call money, it's roughly 10.6% of assets. It used to be 5-6% earlier. And I also see at the same time borrowings up 15% sequentially. Despite, we did a capital raise, allocation to IFC, that was around 9.2 billion. So any rationale on, the borrowing which was done in the quarter, and what was the, cost of that borrowing?
Ashutosh, you want to take that? Or Venkat, Ashutosh?
I'll take that. I think these are the treasury operations basically. So you will see borrowings, you will see the deployment, and that is to capture the arbitrage in money market.
Yes.
So there is nothing, liquidity wise, you can see our LCR that, reflects about the level of HQLAs vis-a-vis our, immediate payments, immediate obligations. So LCR has been consistently above 200%. So there is nothing on the liquidity side, and it's partly because of the granularity of liabilities. So don't look at, one item in isolation. You have rightly picked up both from both sides. So it's basically because of the arbitrage operations. There is no long-term borrowing in the balance sheet. other than the past refinances, which are depleting.
Right. So,
it was also around 78 only. Yeah.
Yeah,
Sure.
CD ratio is 78%. Yeah, right.
Sure. Is it fair to assume the spread we are earning here is, much lower than our business spreads, and hence it's a drag on margins, on the reported margins?
No, drag.
In treasury operations, you'll always have an interbank market spreads. Interbank spreads are not going to be same as your business spreads.
Yeah.
Right. That's what I'm coming to. Once this, there's an arbitrage right now, but going ahead, once the liquidity eases, can that translate into margins, at least the optical margins to improve, which right now in the 320 margins that we have disclosed, there will be a lag because of this. But once this get normalized and the borrowings and both the liquidity ease off from the balance sheet, can we assume this translate into an uptick on optical margins, the 3.2 becoming higher?
See, the total impact of this is not much, when you see it on a particular date on the level of assets and all. It's an ongoing thing, and capturing the arbitrage is the smartness of the treasury guys to look at, spot those arbitrages and capitalize on them. As long as these arbitrages are available, treasury operations would be there. But you can't draw a trend line on the basis of that.
Okay, understood. Maybe it's a quarter end phenomenon. That's why this looks elevated. Sure. I got your point. And my next question is with regard to the employee expenses. In the current quarter, we saw 5.7 billion. I know it's hard to guess, future, but is this sort of steady state run rate of 5.7 billion going to remain at least for the next 2 quarters? Is there any one-off element in this quarter, or this is fully, what we will see in the next subsequent quarters?
Good question, and I think Shyam has already, touched something on that. See, these would depend on your pension liabilities, and your pension liabilities are being, actually passed on to, LIC or some such in our case, it's mandatory to buy annuities. You buy it from LIC or any other, annuity sellers like HDFC or SBI and so on and so forth. So these are some of those institutions from who we are mandatorily required to buy annuities to pay these pensions. That's what Rule 89 Shyam was referring to. So we can't manage ourselves our, pension requirements or so. So when annuities are to be bought, these are all function of where the yields are moving. So if interest rate cycle goes up and all, our liabilities here would reduce, because then you will have to pay lesser for your annuity. I hope you understand.
Right.
So if you are buying for every 1 rupee per month today, if we are paying 160 rupees, which was 135 about 2.5 years back. So once again, if the interest rates move up, that would go down. You will have to pay lesser amount for buying every 1 rupee pension per month.
Anyway, the summary is we expect this 570, 575 to be holding for Q3, Q4.
Sure. Understood. And just last question, on the fee income side, I think we saw very good traction this quarter. And I saw cards fees around 75 crore. How much of this would be credit cards? I know we started the product late in the quarter.
Credit card is too small. It just started. This is debit. We are now a leading debit player in terms of spends, and that's debit-led.
Sure. And in terms of the tie-ups that we've done with fintechs, what kind of fee income run rate can we assume going ahead? This kind of momentum, can we assume this will replicate in the coming quarters? Yeah. Business momentum staying put.
For fee income momentum, we are seeking to keep this and keep improving. Not just by the fintech partnerships, our organic business model is that. So the fintech related outcomes, I'm for this financial year parking. Everything we are saying is an FY23 outcome.
Sure. Understood. Yeah, that's all from my side. All the very best. Thanks.
Thank you.
Thank you. The next question is from the line of Abhishek Murarka from HSBC. Please go ahead.
Thanks. Good evening and congratulations for the quarter.
Thank you.
I'm sorry to interrupt you, Mr. Murarka. Your voice is breaking up. It's not very clear, sir.
Hello. Is this better?
Yes,
this is slightly better.
Sure. So a couple of questions. The first one is, you said that you're looking at a 1.25% ROA 2 years down the line. and currently you're at 0.9, and you're also saying that your NIM target at 3.2, 3.25 are broadly there. Your credit costs are among the lowest historically. So where will this data come from?
I think we've said this. Our business mix, our credit costs are all, there is optimum opportunity to make another 5 basis points everywhere. So it's not going to be one little thing, and there's no one silver bullet. It's a little bit of everything done consistently. And we think that if you model that, this 1.2, 1.25 is possible given the mix of business that is shifting. Credit cards is just picking up. Commercial vehicle business is just picking up. You saw pickup in business banking and commercial banking. Gold loan was muted this quarter. So these are 5 businesses which are higher margin business. PL has been muted. These are 6 businesses which are higher business model. And credit cost for this quarter is a little muted. Credit cost on the generic basis is even 65, 70 basis points. And I'd like to improve that by 10 basis points. 70, 75 basis points, improve it by 10 basis points.
Perfect. And in that context, these new businesses, let's say NFI that you're doing through PCs.
Sorry, Abhishek, your voice is disturbed.
Oh,
sorry.
Okay.
Maybe you're too close to your microphone, probably.
No, I'm on the phone.
No,
Okay.
I believe it's a network fluctuation at your end.
Do you have a headset you can wear? Yeah,
Sorry?
go ahead. Yeah, go ahead, please.
Okay. Yeah, sure. Thanks. Hope this is better. So in this context, what I wanted to know is the new businesses you are doing, which is credit cards or microfinance through BCs, what kind of scale do you see in these businesses, let's say in a couple of years? Just broadly, what is an aspirational target?
What kind of spread did you say?
Scale. What AUM target, like scale?
No, I mean, we are not certainly going to become India's largest credit card bank or anything like that. We are, as I mentioned earlier, we're looking at it as initially an existing to bank customer profile and then build it to the new to bank. So if in a 2-year period we are getting close to say 12, 15 lakh cards, we've done well. And then the dynamics kick in for us. Likewise, commercial vehicles, we've just crossed 1,000 crores. We will build it to about 5,000-6,000 crores in 2 years' time. Commercial banking, business banking put together is about 26,000 crores. We think that is potential to go up to 45,000 crores.
Okay. And any targets for MFI?
Pardon me?
For microfinance?
We are pursuing organically. Inorganically, we have none on hand. I've always said if there's something, we will be very happy to look at it. But unfortunately, nothing on hand just now. But we have not taken our eyes off that. There will be something that will come up in the next few quarters if we search hard. I did say in the last call, we want to see how the environment is playing out. I think they're just getting some stability. So we'll watch for another quarter.
Sure. And the second question, slightly connected, is this digital personal loans. Last couple of quarters we've been coming off. First quarter I understand, but second quarter also there's a sequential drop. So can you explain why that book is contracting and what's the outlook there?
No, it's conscious. In the current prevailing credit environment, if you offer easy to take credit, you may end up becoming a problem. So we're just watching for it. As we go into Q3, we'll see pick up on that.
Okay. And in that book, is there any cutoff? What would be the cutoff, let's say, customer profile in terms of, let's say, CIBIL score or something like that?
I think it's not just one. We create our own score, including CIBIL score. We look at past performance record on that. It's a largely cross-sell to existing liability base. So we have a internal score based on how we model the client profile, and based on experience we keep experimenting at various price points. But we take before delivering the credit, we scrub the bureau.
Okay. And if you don't mind, can I just squeeze in one more question?
I'm okay. The others will come.
Okay, sure. All right. Sorry. Just one very quick one. So just these fintech tie-ups, what is the run rate of SA accounts or the throughput of SA accounts this quarter?
We've done about 3 lakh accounts with both the fintech partners this quarter. Right, Shalini? We've done 3 lakh?
Yeah, Shyam. Yes.
It's running at about, this is little filtered, as in it's like a tap. We disallow and allow at different points in time depending on volume. But I did say in the last call, right, we we think in a normal day we do about 3,500 accounts normally. Now we are running at 7,500 accounts a day.
Okay, perfect. Thank you, Shyam. Thanks for taking the questions, and all the best for the quarter.
Thank you.
Thank you. We would request participants to limit your questions to 2 at a time. The next question is from the line of Ajit Kumar from Ambit Capital. Please go ahead.
Thank you for this opportunity, sir. So a couple of questions from my side. First, what would be your total SMA book now? I believe last week it was 4.6%.
The SMA 1 and 2 is now close to 2%, and SMA 0 is about 1.82%, roughly about 4, little shy of 4%.
Okay. So roughly 50-60 basis point improvement on Q&Q basis.
A little better. I think last count I saw 67 or 70 basis point.
Okay, thank you. And sir, second is on restructuring. So just wanted to reconcile the numbers given in presentation and in result as part of notes to account. So as per presentation, the total restructuring is rupees 3,553 crores, with COVID-specific restructuring being 3,423 crores. Now, as per notes to account, point number 12, format B table, I believe that is the format in which you report to RBI. The total restructuring done is roughly 2,700 crores. So where is the disconnect actually of this? There is a gap of 700 crores. If that disconnect you can explain.
Mani or Venkat or Babu?
Yeah, sir, Babu here. Shall I take this question, sir?
Please.
Yeah. Just for information, in the disclosure format, MSME is not included. Excluding MSME only, disclosure is required. That is why it is different. Yeah.
Okay. And sir, just one last question. If you could talk about your partnership with OneCard as far as your credit card book is concerned. Any qualitative comment on what is the purpose of this partnership?
Shalini, you want to give input?
Sure. Thanks for that question. So this is actually a continuation of our entire journey on partnerships with fintechs. So as we have on the gold loan side, on the microfinance side, on the savings bank account side, as we've launched our credit cards, we've looked at partners who can work with us to acquire, credit cards from the market, and that's how our partnership with FPL is structured. It's a partnership where the entire acquisition and servicing is done by the partner. Obviously, the booking is done by us. The credit criteria are determined in conjunction with us, and they go through a filtering process and they come on book. So it's a part of that overall strategy to expand our presence in the market through fintech partners. It's about a month old now, and a good rate of 200 to 300 cards per day. We're going to scale that up now as we've got greater confidence on the technology capabilities and the interfaces that happen. So that's really, it actually can't be seen in isolation of everything else that we're doing on fintechs.
Okay. Thank you. Thanks a lot.
Thank you. The next question is from the line of Manish Dhariwal from Fiducia Capital. Please go ahead. Manish Dhariwal, your line is unmuted. Please go ahead with the question. Manish Dhariwal, may we request you to unmute yourself and go ahead with your question?
They can queue back, no? You put the next.
Thank you. The next question is from the line of Nitin Agarwal from Motilal Oswal Securities. Please go ahead.
Yeah, hi. Thanks for the opportunity and congrats for a good quarter. A few questions. One is onto the OPEX. Has we fully reflected all the changes on the OPEX in this quarter, and what can be the run rate in the coming quarters? And related to it, with the change in accounting treatment and which has driven this sharp rise in cost income ratio, what number should we now be looking at on the cost income ratio line? Because this is one metric which we have been quite focused and we have been giving guidance. So what is the revised guidance on this?
Yeah, I think we believe, of course, I'd like to keep one more quarter to understand this better, but I think now getting to 52, 53 would be our first milestone by end of this financial year, closer to 52. And then as income picks up, hopefully next financial year, 10 to 50. But at this point in time, I'd guide for 52.
Okay. And so everything is now, sir, reflecting in OPEX, the increase because of the pension, rise in pension contribution?
You would have seen that, no? You would have seen that, no? Listen, the 177 crores is the pension, family pension impact. which will amortize over 5 years, and that's the view. If possible, we'll do it much earlier, but over 5 years. So the incremental impact per month is about per quarter is about 25 crores or 30.
Okay, sure. And
there in the disclosure, note number 13.
Sure. Thanks.
Sir, is it my line that is causing this disturbance, or where is this disturbance? It's terrible.
Yes, sir, it's coming from your line.
So should you connect me back?
Yes, let me do that, sir. I'll disconnect and call you back. Ladies and gentlemen, we would request you to please continue to hold the line. Ladies and gentlemen, please stay connected while we reconnect the management. Thank you.
Yeah, sorry, Nitin, we had to disconnect. Yeah, please. You were talking about OPEX. I did mention, I think Venkat was clarifying further.
Yes, I understand that, sir. Thank you. And so second question is on to the margins. So what will make us more constructive on margins? Like we have been talking about 3.15 to 3.2 range, but if I look at like our CASA has grown around 500 to 600 basis points in the last 18 months. It is growing at a faster rate already and likely to expand further. So what will make us report a higher margin from here?
Nitin, I know I'm not going to be popular saying this, but I think chasing margin in itself is never a good strategy. A mix of business, credit quality have to be factored in. So I would say when I guide for 320, 325, 330, we have factored that in. I mean, we don't have a path to say I can get to 340, 350 without taking disproportionately high risk, which at this juncture we don't have the appetite for, Chief.
Also. And lastly, on to the restructured portfolio, like any sense that you can share as to what proportion of the restructured book is going to turn into bad loans, and what proportion of it is under moratorium right now? Because last quarter you did talk about that the collection efficiencies in restructured book is as good as the standard portfolio. So how that?
I don't think that has changed. We have, I think in our disclosures we've made, right, 75% of the book is LTV and 73% is 100% secured, collateralized. So I think the quality of the book, because it's largely retail, home loan against property book that we have restructured, we're quite pretty comfortable that it's not going to be a runaway problem. And over a 2-3 year period, maybe 20-25% of the book will slip, and which will then be our commitment to the 65% PCR is hold, which is why we started building a provision cover over that. And we are now, almost like 440 or 450 crores provision already built on that book. And in the coming 2 quarters also we will build. So we'll exit the year in such a way that in the 2 financial years ahead, even if we see 20-25% slippage in this book, we can still hold our 65% coverage.
Okay, sure, sir. Thank you so much, and wish you all the best.
Thank you.
Thank you. The next question is from the line of Harshvardhan Agrawal from IDFC AMC. Please go ahead.
So, hi sir, thanks for the opportunity. Just wanted to understand, like all the fintech tie-ups that we are doing, are they actually showing some fee income traction to us? And where does this fee income would sit? On slide number 27, we have a breakup of fee income line-wise. So where does all the fee income that we get from fintechs will sit?
No, fintech fee income is not separately reported. That will come under our debit fee income. So largely whatever our debit fee income, but fintech build at this juncture, we are monitoring the account performance on a 3 MOB basis, how balances are built. If you were to originate through a normal digital channel versus this, they are tracking almost just the way a normal digital account would behave.
Right. And so we do have a tie-up with ICICI Securities for that for a trading account, 3-in-1 trading account. So how's the traction there, and what kind of revenue that tie-up is generating for us?
While we don't declare individual partnerships, you can see that generally our fee income traction is positive, driven by a range of activities, one of which is the partnership with ICICI Securities.
Right. So, sir, in this ICICI Securities or like any of these tie-ups, we do keep the float in the account, and we do earn income on that, right?
Yeah, float income will be ours. Where the deposit is there, the float income will be ours.
Okay, sure. Thanks. Thank you, doctor.
Thank you. The next question is from the line of Bhavik Dave from Nippon India Mutual Fund. Please go ahead.
Yeah. Hi, sir. Good evening. Sir, two questions. One is similar to the first, like the previous question. Wanted to understand if you could give us some clarity on what exactly these fintech tie-ups mean for us, because there are so many of them, and we're trying to achieve a lot of things like the credit card fees, acquiring accounts via Neo. So just want to understand exactly how are we going to monetize them. And second question is related that the other expenses that we have are around 900 odd crores that we did for the first half. How much would be due to these partnerships, or how much of it is linked to business growth? So how much will it be variable that as and when business picks up for us, that growth will grow with the kind of the business that grows? So just want to understand the variability of the other expenses. Yeah, thanks.
Your two questions are in some sense interlinked. Our OPEX increase this quarter versus the previous, like somebody pointed out, about 48, 49 crores. Significant part is because of the variable, and in the variable comes the new account sourcing, which includes the accounts that we source through our fintech partners. So, in some sense, you have to see the fintech partners at three layers. One is the partnership where they acquire for us is like a BC, right? So there's a BC cost. The second is we are a service provider for them, and then there's a certain degree of cost acquisition cost that we bear. So the fintech partnerships, as we see it, is if you had to open 1,000 branches and book another 3,000 accounts a day, versus using our partnerships, using technology and getting to a new client base, which normally we may not be directly getting because this profile of customers don't use physical brick and mortar. They look for more cooler stuff. We are using a front end which is more cooler and contemporary. So our fintech partnership speaks to our theme of digital at the fore, human at the core, branch-light, distribution heavy. And that's why we are investing heavily into this in terms of partnerships, focused by senior people, giving it time, attention, upgrading the back-end capability so that it is highly resilient and be able to give the quickest turnaround to those customers. How will it shape out? How will it play out? It takes a good year to understand that. Early signs are very positive.
Sure. And what we are trying to do is we are trying to get newer segment of customers via these fintech partnerships, right? Like we already have 8.5 million customers on the liability side or debit card side. The incremental customers are reasonably different in terms of the profile, meaning maybe 30 years and below, more millennial type customers, salaried. Is that what we're trying to do with these partnerships? Because we already have a reasonably high base of customers to mine for our existing personal loans and credit cards, right? In some sense.
Absolutely, yes.
So the 3 lakh odd accounts that we source via these fintechs are reasonably younger set of customers. Is that a fair way to think about it?
Younger, I don't know if age is a criteria, but younger in their dispensation to life, you could say.
Understood. Okay. Thank you, sir. Thank you.
Thank you. The next question is from the line of HND from Kotak Securities. Please go ahead.
Good evening, Shyam. Just a couple of questions from my side. One, the recovery was reasonably strong this quarter. Just kind of give us some color. How are you looking at the second half of this financial year? And is there any blind spots to be worried on the corporate side from here on?
First question was what? The recovery was strong. Did you say that, Mahesh?
Yeah.
Okay. Yeah, this quarter was strong largely because we did, Q1 was muted given that first 45 days was relatively low, so we saw higher slippages. Usually from a fresh slippage pool, recovery is usually stronger. So we saw that. We believe that this run rate, not maybe the 400 crores, but a good steady state would be somewhere in the 300, 350, and that we will certainly focus on. On the corporate, are there blind spots? There will be some that will slip over periods of time. Nothing looks too alarming at this point in time. We don't have any single big ticket which is in the 50, 60, 100 crores, which is a problem. But I'm not flagging any risk that should cause anything that... We still think that 400 odd crores, which used to be a normal slippage in a quarter, that's the number we should focus on.
Okay. And all this Kerala impact of COVID or the recent floods, doesn't have any major impact right now?
I don't want to be nasty, but I will be nasty. I don't think this question is appropriate to the bank.
No, it's just a clarification.
No, it is not appropriate. You didn't ask me about Orissa floods. You didn't ask me about Uttarakhand floods. We have managed this portfolio for many years quite sensitively.
Sure. Just one last question on the OpEx line. Just wanted to understand, with the larger parts of your businesses now moving to your subsidiaries, if you have to just kind of take a ballpark assumption, if you were to double the balance sheet on the retail side, do you think you need to put in a fairly large number of employees to match that, or do you think you are in a position right now where your existing employees can start contributing on the revenue side a lot more meaningfully as compared to where it was earlier, because the OpEx is moved to the subsidy?
I think our employee addition for many years has been very muted. If I look back 4 years, our net addition in employees is only about 600 people, while our business is probably more than double, so to say. So I think
that doesn't change even.
Sorry?
In the question that doesn't change even today is a fair assumption to make. There's still a lot of headroom available there.
Yes. Productivity, digital efficiency is very much there. Yes.
Okay, perfect. Thanks.
Thank you. The next question is from the line of Krishnan ASV from HDFC Securities. Please go ahead.
I got my time.
I'm sorry, Krishnan, your voice is breaking. We cannot hear you very well.
Yeah, hi. Is this better?
Yes.
Yeah, Krishnan. Yeah, please.
Thank you. Thanks for taking this, Shyam and team, and very good set of numbers. Congrats on that. My first was just a repetition of what Mahesh asked around the recovery environment. So while this was a one-off and it kind of made up for the loss of half a quarter last quarter, just wanted to understand in general the recovery environment, plus you had an exposure to Air India moving from weaker hands to stronger hands. Does that make a difference to how you look at that particular exposure specifically?
Air India is fully paid off. No, we don't have any Air India impact at all.
No, there is one government guaranteed one, small amount.
Government guaranteed one, that is there, but that is
backed by GOI guarantee.
Yeah, that is government guaranteed. No, so that is not an issue.
Very small amount.
But in general, the recovery environment, do you think, is something that helps you get to a 300-350 crore run rate?
It has improved, Krishnan. Environment has certainly improved. That shows in the recovery and upgrade.
Okay, understood. So I'm done with that question.
Okay.
Thanks for all the best. Thank you.
Thank you.
Thank you. The next question is from the line of Jay Mundra from BNK Securities. Please go ahead.
Yeah, hi sir. Good afternoon and thanks for the opportunity. Sir, first question is on ECLGS. If you can quantify the outstanding number that we have. And secondly, once these loans, when they, I think this quarter, September or maybe July to September, they would have completed the first year of moratorium. Are you seeing any, if you can share your thoughts, once these accounts have come out of moratorium, how are they behaving? Or how should one look at it, the stress from this portfolio? Yeah, sir.
The second part is easier. First, the prepayment this quarter was bang on, so we didn't see any stress on that. If we can forecast that for the remaining quarters, we are a very happy team. But that is hard. But at this point in time, the GECL portfolio is very small repayment requirements, was good. Book restructured, if I remember, 700 crores. Harsh, should you know? I can't recall the top of my head. Harsh. Would one of you know?
Which one? Sorry?
GECL total restructuring. Total GECL book. Around 2,700 crores is my recollection.
Yeah, nearly 3,000 crores.
It's around just a shade below that, Shyam. But with the new announcements, there will be some more disbursements, but as of now, it's there.
So, sir, the question is, so far, anyway, this portfolio was under moratorium. And maybe in the beginning, in the later part of this quarter, you would have seen some accounts coming out of moratorium.
Their repayments were perfect.
Sir, Babu here. In a supplement
right, Babu?
Yes, 17% of the book has come in demand bucket, and we did somewhere around 95% collection. Absolutely, there is no challenge, particularly with regard to the moratorium or structured books so far on the demand book.
Understood, sir.
In short, I think if we can sum up, I think our recovery percentage is in the restructured book is quite similar to the general book.
Exactly.
Right. And second question is on restructuring the nomenclature. So let us say you have restructured 2,000 crores of retail. If a customer, he had taken a prudential restructuring and he wants to repay on time, he can still do. But at what stage you would untag him from restructuring? Is there any clarity that, by what milestone would you untag him from restructuring?
Babu, yes, sir. Restructuring is done for 24 months. That is the maximum tenor that is permitted. After this 24 months, his account will untag from the restructuring book if it is not turning into LCA by the time.
Okay, so even if he is perfectly standard, even if he has repaid some amount of it ahead of his schedule,
it will remain flat as restructured up to the end of this 24 months. That is the maximum tenor.
Let me add, I think in the past there had been so many restructuring, done under CDR, this, that and all. If you see, we always present to our analysts and investors the slide on which we show the path of restructuring. So once an account is tagged as restructured, earlier we used to continue it till it is fully repaid and all. And that's what you would have seen in graph. It used to be that amount used to be 3,200 crores and all, and gradually it had fallen to 600, 700. This is a special restructuring that has happened under COVID. 2 years is a moratorium period. We'll watch it after moratorium is over, how long it is behaving properly, because these are mainly housing loan accounts for 15 years, 20 years, 25 years or so. So maybe after 2-3 years of satisfactory performance post moratorium, we'll remove the tag, but that we would share with you, through a slide and all. It's so much we have taken out of that book.
No, even otherwise, sir, it remains in standard bucket.
Yeah, standard it remains. I'm talking of, removing that tag of restructuring. So I think for that some, trend should be there, post moratorium. We'll watch it for a couple of years or so and then, disclose it that this is what we are removing from restructured bucket.
Understood, sir. And the last thing, sir, I missed your comment wherein you had said that you have done some estimates basis, some relapse from outstanding restructuring, and then you have made some over and above IRAC provisions. So if you can elaborate, sir, if you have any done provisions on the expected restructuring, or did I
in a most conservative way, we are expecting that there would not be a slippage of maximum slippage could be 30% from this, which this is a sort of very conservative estimate. The number could be much lower later on. But assuming that it is 30%, 25 to 30% slips and all, on that we need to have 65% PCR, which is we have been maintaining for last so many quarters. So if we have to maintain 65% on that 30%, 25, 30% of restructured work, then how much provision we need to hold? So on that, I think Shyam had shared, we already are holding 450 odd crores, and we will gradually build up, because post-moratorium then we would actually be knowing whether it is slipping or not. So for that, in advance, we are building up the provision. And that's what that management outlay, we already have additional provision made in this quarter itself.
Right. So 450 crores is the restructuring provision outstanding, right?
Yes. Babu, is the number same now?
Yes.
Yeah, sir, it is. That is outstanding provision for RF1 and RF2 together.
Yeah. Right. Thank you, sir, and all the best.
Thank you. The next question is from the line of Gurpreet S. Arora from Aviva Life Insurance. Please go ahead.
Yeah, hi. Thanks for the opportunity. So one quick question is on the restructuring. In your opening remarks, you mentioned you've done around 1,000 crores of restructuring. Last quarter, I think the guidance for this quarter was 400 odd crores. So where has the incremental surprise for us come from? And second, if you could reiterate the slippages guidance for this year at FY20 levels plus minus 10%, which you alluded last quarter.
Yeah, I think you picked up half of my statement. You only picked up my restructuring comment last time about 400, 500 crores, but you don't pick up the slippage part. The slippage is half of what I thought it would be. So on balance, between the two, slippages and restructuring, this quarter is also roughly about 1,400 crores, 1,300 crores. Not very wildly off from what we had visualized. The good news is slippage didn't happen. The even better news is the customers who opted for restructuring are secured, and therefore that's the blend that we see. Sorry, what is the other part of your question?
So your slippage guidance, as what you mentioned last quarter, do you maintain that?
The full year slippages we had talked of somewhere in equal to what it has been for the previous 2 years, which is roughly 1,800 to 2,000 crores. Current trend line suggests it could be better, meaningfully better.
Sure. And my last question is if you can comment a little bit on the business environment, especially on the SMEs, and any sort of cautious industries or geographies you wish to highlight.
That's very geography sensitive or sort of sector sensitive, and it keeps varying. But we've generally stayed off hospitality and those that are heavily contact sensitive, right? Obviously, and that's why our slippages are well in control, because for years we've kept away from those segments. So that will continue. Business environment certainly better than what it was say last financial year. Most of last financial year. Last quarter was good, and the quarter that went by, for period starting I think July, August onwards, we've seen momentum. I am quite confident that second half we will see much higher growth than first half.
Sure. Thank you so much, sir. Good luck, sir.
Thank you.
Thank you. The next question is from the line of Rishikesh Oza from Robo Capital. Please go ahead.
Hello.
Yeah, hi.
Hi, sir. Sir, just one question from my side. If you could give any guidance on credit cost and loan book.
I think loan book, I just mentioned that, Y on Y we've grown 10%. We think now business momentum picks up. Somewhere in the teens this financial year is possible. We're pushing for higher, but yeah, somewhere in the teens. Whether it's mid-teens or high teens, we will see in the quarters ahead, quarters ahead. Credit cost this year will be a kind of a mixed chief, because Q1 was high, Q2 was nil. So let me not comment on it. Suffice to say our overall full year credit cost somewhere in the 70 basis point, 80 basis points, which you should factor for.
Okay. And next year?
We'll give you a guidance closer to the year.
Okay. Thank you.
Thank you. The next question is from the line of Franklin Moraes from Equentis Wealth Advisory. Please go ahead.
Yeah, so thanks for taking my question. So could you throw some light on the outlook for Fed FINA?
They're doing well. They're focused exclusively on small business, small ticket size credits, LAP, gold loans, small business lending, and we're quite happy with the progress.
So in terms of growth, if you could share, whether they will also be, growing aggressively?
They have been. Through the pandemic, of course, we were all watchful. Their credit standards are good, and their book is now at 5,000 odd crores, and I think they're positioned for growing at maybe like 30% a year or more. They're doing well.
Thank you.
Thank you. The next question is from the line of Nilanjan Karfa from Nomura. Please go ahead.
Hi, Shyam. I hope I'm audible.
Very much.
So, just one question on this NRI deposits, the remittances where, where we have done a phenomenal job. Just checking, this is the amount which flows into our deposits. We are not actually originating it. Is that how you measure it?
No, this is money that flows through the pipe and comes through as remittances. Not all of it become my deposit. I would love it. A part of it becomes, the end user, end beneficiary could take the money and take it away for end use, which is not placed in the bank. This is money that flows in through us. We are a pipe for that money to come in. As a part of our management, we try to keep a large part of it. We encourage the customer to bank with us.
Right. And therefore, in that context, I was just looking at that NRE deposits, right? I think for many years now, I think this is the first time the Q1 we had the QOQ had a decline in the September quarter. Anything, does it point to anything about utilization of these or any sort of weakness in the environment? Or I'm reading this too much into these numbers?
Maybe Shalini or Suresh can give you a better color, but generally I wouldn't read much into it simply because that usually is when the Onam comes, and also the last 4 months have not been the best period for non-residents, right? So to that extent, movement of money may have been lower, and also as rupee strengthened. Now we saw October rupee became 75. And
I was about to say that. Actually, it's a function of how the exchange rate behaves.
That's what I said. After rupee became 75, the floodgates were opened again.
Right. Okay, fair enough. And last question on that restructuring. Roughly, what kind of moratorium have we given, or when should we start looking at a large bulk of restructuring to come through and the repayment,
I think the 3,500 crores over the next 9 quarters is divided in different segments with about 800 crores, due repayments in the next year first quarter, right, Babu? Is that the number, if I recall right?
By September next year, roughly 80% of this book will come in demand book. By now it is 17%. So the most of this book may come towards the Q4 and Q1 and shortly to Q2. So by Q2, the demand book may be somewhere around 80% of the restructuring.
Okay, brilliant. Sorry, a final question, Shyam. When do we see the new investments that we are doing on the retail side to start showing up in the profitability numbers?
I think they are all showing up in its own little ways every quarter. You saw fee income pick up nicely. And I think every quarter you will see. I generally believe never a silver bullet, always a little bit better every time. So I am not committing to, and this is my philosophy and the bank's philosophy, not mine. And we will live up to it, and I will stick to that. We won't promise something which we don't have silver bullets. Others do have, we don't have.
Perfect. Thank you so much, sir.
Thank you.
One point from clarification my side, Q2 23, 80% of the demand book is coming.
It's not, that's what I thought, it's 23.
Yeah, 23. I stand corrected, sir.
Yeah.
Thank you. The next question is from the line of Madhu Gupta from Quantum Advisors.
Operator, we must bring this to a close after 2 questions, please.
Thank you, sir.
Thanks for taking my question. Congrats on a good set of numbers. The first question is, in your previous call, you said that, what percentage of the employees are on the defined pension plan which you expect that they will retire by FY24, and what are the kind of cost savings that will accrue to the bank as a result of that? And my second question is on, there have been some reports that you plan to list your subsidiaries, Fedfina. So could you give some more color on it when is expected?
On the pension, we didn't say the last of the employees. The last of the employee will retire in 2047 or 20 whatever. But a large number of the people who were onboarded before April 1, 2010. Majority is year 24-25, and after that it will taper down. So to that extent, our annual pension cost is roughly 400 crores incremental that we've been providing for the last, say, 4-5 years. That should see some improvement of at least 30% of that in the period starting 24. On the second, really, I have no comments other than we also read some press articles that you said, so I have really no comments.
There are no plans of listing as of now. It's not confirmed report.
When something is required to be announced, we certainly will.
One more question that I would like to ask. Like last year, you had said that there has been some slippage on account of the exposure that you have to the UAE exchange of 1.75 billion. So what is the color on that? I mean, what is the status right now? Have the slippages increased or there's some kind of recovery over there?
That's fully provided. We have not got any recoveries there yet. We are working through it. We have the security, but it's a very complex legal process that is underway. At this point in time, I have no incremental update other than the fact that the process to recover is underway. We are fully provided.
Oh, that is it from my side. Thanks a lot.
Welcome.
Thank you. We'll take one last question from the line of Ankit Sharma, an individual investor. Please go ahead. Ankit Sharma, your line has been unmuted. Please go ahead with your question. Request you to unmute yourself and proceed with your question.
We may have signed off.
There seems to be no response in this line.
Okay.
As there are no further questions from the participants, I now hand the conference over to Anand sir for the closing comments. Please go ahead.
I would just thank everyone for joining the call, and I wish you happy Diwali, happy Christmas, and a happy New Year in advance.
Yeah. Thank you very much.
Thank you.
Thank you. On behalf of the Federal Bank, that concludes this conference. Thank you for joining us, and you may now disconnect your line.